What is going on, traders? Welcome back to the Traveling Trader. Today I'm going to talk about the big elephant in the room, something that's on everybody's mind, even if you're not really paying attention to the markets, and that is the topic of recessions. And what should you do in a recession to protect your money, protect your portfolios, protect your investments? Even if you don't have a ton of money exposed to the markets right now, it's still good to know what to do in case a recession arises. And I promise you there's something for everybody here. If this is your first time on the channel, go ahead and hit that subscribe button and hit that notification bell. If you want to, you can wait till the end and see if you like what you see. If you get anything out of this video, go ahead and leave it a thumbs up. And if you have any questions, leave it in the comment section below. So what exactly is a recession? Well, I won't get into the nitty-gritty because depending on which economists or analysts you have, it's actually a loose term. It's not as defined as you think it is. But in general, we can think of it as 2 consecutive quarters of negative GDP growth. However, most retail investors and most regular people define a recession by the actual consequences of the recession, which is you see your stock portfolio decline, you see your house price decline, you might know many family members or friends that are struggling to find jobs, etc. Those are actually the effects of the recession. And it's all due to the wavering confidence of businesses and consumers alike, which creates a trickle-down effect, and that bleeds into the whole economy. All right, so why is the mainstream media actually focusing on a recession now? What is it now that is causing people to focus on a recession? Well, there's a number of reasons for this. You have the obvious ones, right? The trade war in China. That 2 biggest economies in the world are at battle currently, and it is causing negative ripples in the market. Couple that with the fact that we've been on an 11-year bull cycle, which is virtually unheard of. So people already think that the house of cards is ready to tumble. Mix that in with slightly more complex topics such as the inverted yield curve, which is just a fancy way of saying you get paid more now instead of later, right? The short-term interest rates are actually higher than the longer-term ones, meaning you can either get $4 in 2 weeks or $3 in 2 years. And then the upcoming election cycle, yada, 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 you have a recipe for potential disaster, and at least there's enough fodder there to keep the media talking about an impending economic doom. Now, as you can imagine, you don't have to be an economist or a market analyst or market strategist to know that there are probably differing opinions on what to do in a recession. Lucky for you, I'm going to present those different scenarios, and I'm sure you'll find one that's applicable to you. Keep in mind that I'm not your financial advisor, so go ahead and consult with whoever you need to protect your shit. All right, so at a high level, the basic 2 strategies in a recession is either you ride it out, because time over time it shows that the market will eventually regain and rebound and surpass previous highs, or proactively change your portfolio distribution. Either approach, the main thing to consider is keeping a big picture focus on what is actually a recession and what is likely to happen after the recession. If you look at a recession as just an inevitable market cycle and you don't need the money that you have tied up in your investments currently, then sure, you can write it out. You might have to make some minor adjustments here and there, such as say that you are currently invested in some pretty high risk stocks of companies that aren't blue chip, that don't really have a solid balance sheet. They do have potential in an emerging market, but in a market decline, they're gonna get gobbled up. Now, if you own a ton of stocks like that, yes, you might want to redistribute that and put those funds into more blue chip stocks. So, fun fact, the first time that I made a lot of money in my life was 2008. In 2008, I was sitting on my desk at work, working a 9 to 5, and the crash happened. And I remember in 2009, the Dow hit something like between 65 and 6,700, which was astronomical. Something that's now well over 25,000. And I thought to myself, do I really believe that this is the end? This is the end of companies like Intel and Nike and Apple and Google and Ford and GE. Do I really believe that this is the end of those companies? And if the answer is no, then I'd be a freaking idiot not to put every dollar I can into those companies. Now, this was obviously after the crash already happened. And of course, those companies rebounded, and that was really the first time that I made a killing in the market. All right, so aside from blue chip stocks in general, one of the safest sectors in the stock market and the equities market is consumer staples, because this is usually the last thing to go off of people's shelves during a recession. Consumer staples are basically just food, drink, hygiene products, etc., even alcohol and tobacco. Yes, you can imagine why these are the last things to go in a recession. But during past recessions, consumer staples actually do incredibly well, all things considered. All right, so apart from de-risking your stock portfolio just a bit, another thing you can do is adjust your allocation. So instead of having 35% in the stock market, you could taper that down to say 15 or 20%. And where would you put that extra cash? Well, cash is also a position, something that people seem to forget. It's as if people are allergic to cash. They always want to have their money tied up in this investment or that trade or this potential growth opportunity, but cash is also a position. And during a recession, if your wealth is mostly tied up in cash or a treasury bill, then you are likely to earn around 2 to 3% a year just doing nothing, because that is the current risk-free interest rate, which is equal to the current T-bill rate. So cash is also a position, especially in a recession. Another thing you could do is put that extra money in a fixed income market, such as a CD, certificate of deposit, which is just a high yield investment that keeps your money tied up for a fixed length of time, or government bonds or T-bills, etc. The last one I'll talk about in a more risk-averse strategy is commodities, right? Such as gold, silver, oil, etc. Commodities generally do well in a recession because they're not tied to the equities market. However, you have to keep in mind that commodities are based on global trade and not just the US economy. So if there are global factors or geopolitical factors surrounding some of these commodities, then the price of those commodities can also go down with the US equities. Now, as I said in the beginning, if you don't need this money at all, and you don't really feel like you are a savvy trader or don't really know how to shift money around or don't really want to keep track of different investments, and all you want to do is just stay put and ride it out, yes, you can surely ride it out, assuming that you live long enough to actually see the market recover again. But if you're dead, it doesn't really matter. It might matter for your kids or whatever. But anyway, I digress. Now, for the more risk tolerant and the more trade savvy, there are a few extra things you can do in order to try to maximize the amount of money that you make during a recession. And no, buying and holding is not one of these things. This is for the truly risk tolerant people. When the market starts to turn and we start to create new lows, essentially you want to be net short. The only way to make real money and maximize, squeeze every last bit of profit that you can in an economic downturn is to take some risk. So when the market does start to turn and we start to create newer lows, you essentially want to be net short. Well, how can you be net short? Well, obviously, if you know what you're doing, you can short the market using leverage on your exchange, etc. But there are a few ways to short the market without using leverage or without actually shorting a stock. And people don't really know about these, and I'm always surprised how few people know about these mechanisms. One of the easiest ways to short a market is not to short the stock itself, but there are ETFs that actually trade inverse to the markets themselves. If you are part of our trading community on the Discord, you see that sometimes I speculate on crude oil using UWT and its inverse DWT. Well, there are inverses for virtually every market. There's an inverse for the S&P 500. There's an inverse for the NASDAQ, for the Dow Jones. There's an inverse for consumer goods, consumer services, etc. I'll leave some links in the description below, but essentially these ETFs trade like stocks. They have their own tickers, and all they do is they move inverse to the market. So when the market is tanking, these inverse ETFs actually go up and vice versa. So you can actually short the market without having to use leverage. Now, obviously for the truly savvy, you can actually short the stocks themselves. And stocks that usually get hammered in a recession are stocks that have terrible balance sheets and no income whatsoever. And you can usually find these scattered around the biotech and technology sectors. Their valuations are all based on speculation anyway. And if you want to pick a single index to short in the market as opposed to individual stocks, the Russell 2000 Small Cap Index is the perfect place because it's usually littered with these companies that I just described. Now, if you are truly risk tolerant, another thing you can do is go long the VIX. The VIX is basically a volatility index. Yes, you can long and short volatility itself. And there are multiple ETFs that follow the volatility index. But as we dip into a recession, volatility goes up. So you can actually play the VIX and go long the VIX. However, I wouldn't go long on the VIX for an extended period of time. You'll see how volatile the volatility index is. It lives up to its name. You'll see how volatile it is, and you'll want to make quick jumps in and out. Again, this is for the truly risk tolerant who knows what they are doing. And obviously, even if you're the risk tolerant type, you could still go long commodities such as gold or US treasuries themselves, just as somebody who's more risk averse would. You could still allocate certain parts of your portfolio in these more safe investments. But I will say, regardless of whether your strategy is more risk averse or risk tolerant, buying the dips continues to be the easiest way to make money in any market. And you don't have to be savvy to do this. Obviously, when the Fortune 500 company stocks fall, or the blue chip stocks fall, or the housing market crashes, you can essentially put your money in some of these investments waiting for the market to rebound so you can collect your profits. And just so I say it, taking excess risk is unnecessary. Be sure that you are operating within your risk tolerance. If you don't know what you're doing whatsoever, talk to a financial advisor, do your own research. Remember, cash is also a position, so just because you're not in stocks or bonds or ETFs or housing or whatever, it doesn't mean you're losing. Markets will continue to cycle in and out, and you will always have a chance to buy the dip and make money in recessions and downturns and rebounds, etc. Trust me, I'm only in my 30s and I've seen two of the biggest crashes in history happen in my lifetime. That is it for this video. If you like what you see, go ahead and subscribe to the channel. Hit that notification bell, leave a comment if you have a question, comment, agreement, disagreement, etc. Leave it in the comment section below. Hit that thumbs up if you get anything out of this video. Join our premium trading group if you're interested in stocks and crypto trading, as well as ETFs and options, etc. We send out trade signals, talk strategy, go over top stock and crypto picks, etc. That link is in the description below. If you need help with technical analysis, trading strategy, trading lingo, etc., I do one-on-one sessions over video conference. I take a maximum of 10 people per month. Hit me up if you're interested in that. That same link is also in the description. Stay safe out there, traders. Peace.